Welcome back. There's 3 minutes to go for the pre-open session to kick off. Manoj Muralidharan is Vice President, Derivatives at Religate Broking. He's joining us to take some questions. Manoj, great to have you with us here. Thank you very much. How are things looking, Manoj, as we start another day? I mean, it's pretty hard to, I'm assuming, trade, right? Easy to comment, but you've got a massive gap up, a massive up day on Friday. We start lower again. Keep the faith by the dip, Manoj, or something different today?
Good morning, Prashant. I like the way you ask questions because, that comprehends to majority of the traders that we have, at least in the index. Now, Prashant, a better way to get into this market or understand the trade is if you see the October series, generally on an average, when I'm saying, let's say the last 3 months, FIs have a pattern. They have at least, let's say, a 40% on the long side and 60 on the downside, on the short side. But this month of October, we have seen them go aggressive, almost 85%, thanks to the dollar index and the USD that we are seeing. So the equation here is October series with almost a position of 1.1 crores has got major short at an average of 17,400. Now this is the equation that the FIs have. Now to answer the second half of your question, which is said on Friday. So Friday, yes, I guess there are other participants in the market as well who have garnered long positions. The average is somewhere close to 17,000. So in the short term, there is a 300 points range in the Nifty. Buy the Nifty closer to 16,900 to 950. This is specifically for today's trade, and the target on the upside would be 17,100. Now 17,100 to 150 would act as a resistance. So strictly intraday traders can go long on the Nifty for this 200 odd point. That could be the suitable trade to do at this point of time.
Okay. Any individual stocks?
So Friday, the rally, there was good amount of large cap stocks which has contributed. So we like HDFC Limited. We believe the stock has a potential to go to 2360, 2380. The better way is you can go long with a target of 2380, and the stop loss should be somewhere close to 2275 on that. We like Infosys as well. We believe 1440 to 1450 is where the stock is headed to. So you can go with a call option that a 1440 strike. Try to buy between a 28 to 30 rupees, keep a stop loss of 10 and a target close to 60 rupees of that.
Okay, well, thanks a lot for that. Have a great day. For now, we have a couple of more stocks as we head into the pre-opening rates. One of the stocks of the day undoubtedly could be Eicher Motors because of very strong numbers that came through for Royal Enfield. So let's just put that on board. Royal Enfield sales hit a record high in September. The total sales went up 145% on a year-on-year basis, and it's been a very strong response that the company has seen to the new Hunter 350cc bike. If you look at the monthly trend, and a graph will be up for you in a bit, on an average, Royal Enfield sales were averaging anywhere between 60 to about 70,000. And okay, well, the September sales will come up in just a bit. That's from Jan to May. But this is the real graph that you need to look at. In June, Royal Enfield was at about 61,400 and all the way to 85,000 in the month of September. Remember, the stock chart is also very similar. The stock is up almost 41% in the year gone by. So that one is going to be in the green this morning.
Absolutely. That's, that's autos for you. Let's talk about the oil and gas sector, which is making all the news this morning. While gas prices have been hiked to $8.57 per MMBTU for the second half of FY23, compared to $6.1 in the first half, the government has revised windfall gains tax as well. It's cut levy on crude to 8,000 rupees a ton from 10,500 earlier. Duty in petrol exports remains nil, while that on diesel is cut to 5 rupees as well. We've got Mr. Kirit Parikh joining in, Chairman at Integrated Research and Action for Development, and Harshvardhan Dole, Vice President, Institutional Equities at IIFL, now joining in to take some questions. Gentlemen, it's a pleasure. Great to have both of you with us here. Mr. Parikh, talking to you after a long time. It's great to see you, sir. Just to start with the gas price bid. The government has bitten the bullet. It's increased gas prices. But where does the revision to the formula itself stand at? Because compared to what the calculated price should be, what has been announced is lower, much lower. So where does that leave us?
You see, I think our committee was given just 15 days to suggest what should be the price of APM gas.
Yes.
APM gas is the gas that comes out of ONGC and OIL fields, which were earlier allotted to them on a nomination basis. So APM gas is a small fraction of the total gas consumed in the country. And so the price increase is only for the APM gas. It's not for all the gases in the country. That price, much of it is market determined and depends on the cost of imports and other things. So APM gas, there are, you might say, 5 different stakeholders. One is the ONGC and OIL who produce gas, and they are obviously interested in having a price as high as possible. The second is government, who, because APM gas goes to fertilizer manufacturers, higher APM price will increase the amount of subsidy government would have to give to farmers. And therefore, the government is one of the stakeholder in terms of the effect on its budget that such a price increase might have. At the same time, you have to recognize while the subsidy burden increases, maybe the government's share also marginally from ONGC's profits would increase. The third stakeholder would be CGD operators, distributors, and the consumers of CGD, which are private companies who.
Right, Mr. Parekh. Just to completely get the point, and you've explained that very well. My question was about the formula used, sir. I mean, the price as compared to what the spot prices are, and the formula and the price that got us. This is lower, the APM gas price which has been approved. I'm talking about the formula which has been used, and yeah, go on.
The formula was more or less suggested in 2012 and somewhat supported in 2016 report of the secretaries, which really tries to give the same price to Indian producers of APM gas as prices producers get in international market. So that price really does an average of the price received by producers in United States, Canada, Europe, Russia. And therefore, that price is the one that government uses that is the formula that has been used. Now, one can raise the question whether in a competitive market, do you equate the prices at the producer level, or you have to have the price at the consumer end, which is certainly equivalent to the alternative options available. And I think we are examining this, and we will come up with our ideas on the subject in a month's time, latest by end of October.
Okay, latest by end of October. Harshvardhan Dole is also with us. Harsh, good morning. So, for city gas distribution players, what's the approach now? The price hike has happened, of course, because of course the report has not been submitted yet, but it's slightly lower than what was anticipated, but it's still a hike, it's still a steep hike. So how do you approach these listed players now, Harshvardhan?
See, the way we see things, instead of looking at city gas distribution companies seamlessly passing on any input cost and trying to analyze what is going to be the spot margin or the month YTD margin, etc., I think investors would need to take a slightly holistic approach, see the margins on annualized basis, let the companies balance out equation between price and volume, which eventually will lead to a steady state earnings growth. So we are not that negative on these companies. In fact, we like these companies over some of these commodity players a lot more. And we think that in case there is a sharp correction in the stock prices, which is what we have written in our note, it should be taken as a good entry point. Particularly IGL and Gujarat Gas to us stand out well in the sector. These two remain our preferred picks.
Mr. Parekh, just on that point of CGDs, one of the risks which has been highlighted quite a bit is that with the general gas shortage, right, and prices skyrocketing in global markets, will the government divert gas towards fertilizer companies for urea, etc., away from CGD companies? Could you talk to us about that? Will all of this also find a mention in the report that you will come out with later?
Certainly. You see, what happens is today, fertilizer companies get a part of the total gas requirements from APM gas. Similarly, CGD companies get a part of its total gas distribution from APM gas. They both complement it with imported gas. And the cost is then that becomes an average cost, average price of this imported and APM gas. And that's what they're doing. So CGD companies has really been using also substantial amount of imported gas along with the small amount of APM gas they get. Of course, that the low APM price was so low for some months that it was not even covering the marginal operating cost of production cost of ONGC, etc. So the need for increasing price was there. Formula would have given us some price of something about $9.
Yes.
$9.6 per MMBTU. The government has decided to keep it slightly lower and have gone somewhere in between the two, what the price would have been if the current regime was continued, or if what the formula would have given. So I think there is some via media here, but I certainly think that we have to take into account the impact on all the consumers, whether they're domestic pipe natural gas users or compressed natural gas users of transport sector.
Just one quick question, Mr. Parekh. You know, LNG prices are expected to shoot higher in the coming years, largely because of what is happening in Europe. I mean, they're cutting the natural gas usage coming from Russia down to a trickle. They're expected to, which means that they will still need the stuff. So basically, import LNG. So prices are expected to rise substantially. What is the broad thinking for in the part of the government? And I mean, you're of course you've been for a long time an important advisor on these matters. What's the thinking in terms of dealing with this here in India, sir?
What one has to recognize is that many import of LNG taking place in the country is based on a long-term contract, and the average price of imports in India is substantially below what the spot prices in international market is. And obviously, if the international market prices go up, then we have to decrease the consumption of this, reduce the consumption, because you cannot expect the government, that is people, the general public, bear the cost of this price for few who use this gas.
No, so then you are in a way indirectly telling us that how should we read this? You're saying we should reduce the cost of this. Who should
reduce the cost?
Reduce the use of this. I mean, who, sir? Who are you? Which is the segment you're referring to, Mr. Parekh?
No, that's difficult to say who should. I mean, it affects everyone who are using this.
Yeah.
Certainly, the fertilizer company would not be asked to reduce their use simply because the fertilizer, the consumers are farmers, and for food security, etc., they have to be given the highest priority.
Got it, sir. Harshvardhan, I mean, that gives us an indirect sort of, Mr. Parekh is telling us clearly where the cut will come in from. It'll most likely not fertilizer, but everywhere else. Any thoughts on that very briefly, Harshvardhan? And how are stocks trading right now relative to the impact that the announced APM gas price will have on the earnings for them? Any buys and sells here, according to you?
Sure. I think, in my opinion, the sector which might see a significant cut down in consumption is power. Because at landed prices of even the revised APM gas price, the variable cost for a gas-based power plant will go up by almost 30%. Earlier, I mean, gas power plants have been operating at single-digit PLF, and which will mean that, these become further unviable. So more gas eventually will trickle down to other sectors. I think CGD will see, a lot of volatility in the input cost, which, companies are bracing for. They are bracing for, novel infrastructure, cutting down the OPEX, so that the overall margins can be maintained. We like the sector, and I think relative to the development which has happened, I think it is more or less there in the price. everybody was bracing for a steep increase in APM gas price. And that is how the first half numbers are shaping up. I have not seen across any consensus downgrades, neither have I downgraded the numbers. And to that extent, the stock may not fall significantly.
Got it.
And if they do, to me, it's a good entry point to buy.
Absolutely. Gentlemen, thanks a lot for joining us. Good talking to you. Of course, we will. The situation is still evolving. Let's see the pre-open rates, by the way, now. They are not as bad. In fact, the Nifty has ended in the green. And now it will be interesting to see the SGX Nifty still being the traded rate. The Bank Nifty is down 187 points. Let's take the 9-10 call. Sudarshan, if we open here, this will be much better outcome than what the SGX Nifty told us. Is that a buy signal, or is that telling you that maybe you just wait it out and see how things move? And what's the 9-10 call?
Well, I would still look to go short around 17,100 or 17,150. That's an intraday short, or maybe carry it if it makes money towards the end of the day. As State Bank is a buy with a stop under 516.
Thanks a lot for that update. Let's now, before markets open, go across to Yash. He is standing by with some key takeaways from the SEBI's board meet. Yash?
Well, Anuj, it's been a long agenda which SEBI approved on Friday, but I've managed to pick out 5 crucial points which came out of the board meeting, and 3 of them have to do with the IPO of the primary market. The first one is with respect to stricter disclosure norms when it comes to IPOs. Do remember, this is not for new age companies particularly. This applies on all companies wanting to come out with the IPO. So what is the change? These companies now will have to disclose the key performance indicators, which are not your traditional indicators like return on net worth, return on equity, your net profit. Key performance indicators specific to different companies will have to be disclosed in the DRHP, making it more clear to investors in terms of how the company is performing. The second one is a new thing has been introduced in the IPO market, which is pre-filing or confidential filing of IPO papers. What that means is that you communicate bare minimum to the regulator initially, get market regulators' comment, and as you firm up your plans for IPO, you communicate all the important sensitive business information to the regulator, which also goes out in the public domain. What this does is that if the company last minute decides to not go for its IPO, its sensitive business information does not get disclosed to the larger public, to its competitors. The third one is with respect to price per share. Now companies coming out with the IPO will have to disclose the price per share of shares allocated to the investors in 18 months prior to the IPO. If there have been no transactions in the previous 18 months, then in the last 5 years, which lie in the 3 years prior to the IPO. There have been also changes which have been made around the strategic divestment of PSUs and the open offer regulations, and finally mutual fund units have been included under insider trading regulations.
Okay, Yash, thanks a lot. So that's the photo finish. Let's now focus on the market opening. The first rates are in, and the Nifty is down about 12 points, 16 points now. The Bank Nifty is down 200 points. Nifty is down 32 points. So somewhere in between the SGX Nifty and the pre-open. I mean, not obviously as bad as the SGX Nifty indicated, but not as benign as the pre-open also indicated. Now down about 48, 50 points. Let's see. Not exactly aligning yet with the SGX Nifty rates, but suffice to say that it's a bit of a gap down. I mean, it will still classify as a bit of a gap down. Down about 66 points on the Nifty now, and about 250 points on the Bank Nifty. In terms of individual names, ONGC stands out clearly. That's up 4%. Double factor, of course, the windfall gain tax being cut and this gas price being hiked. The Nifty is cutting its losses now, by the way. So maybe the impulse of the market is back to buy on dips instead of sell the rally. But let's wait it out. Eicher Motors, Maruti, the auto stocks basically doing well, reacting to its sales numbers. Lever, Britannia, Titan. So consumption is doing well. Reliance, of course, is doing well. There's buying happening in Cipla, Bajaj Auto as well. On the way down, you have some of the metal names, which is because of the global risk off, I guess. So Hindalco and JSW Steel. Mahindra is a bit soft. TCS, Tata Steel, HDFC Bank, Infosys. These are few names on the downtake. The mid-cap index, by the way, is already moving in the green, Prashant. So let's see how the rest of the day pans out.
I mean, it's incredible, right? The resilience. 300 stocks at sort of separate advances and what's down, and it's advances over declines right now. But fast-changing screen, so we'll see. 40 points lower is what we have on the Nifty at this point. I mean, Eicher is down about 1.7, is up about 1.7. ONGC starts about 4%. We were just discussing the gas price impact with, two experts. Ashok Leyland is starting about 2% higher. Adani Transmission is up 2.25%. There is Tejas Networks up 1 1/3. MCX is up about 1 1/3. Apollo APL Apollo, sorry, is up 1.5. Rights, Liberty Shoes, Oil, Paytm. So lots of things moving around. And this is the bulk of what is gaining. 1:1 now. Basically, advances have sort of come off. So 1:1 is the advance decline now with 2 minutes in as far as trading is concerned. Let's put up Z if we can and see what's happening there. Will be interesting. The price action sold off quite aggressively till Thursday, and then on Friday it went up some $10. So at about 260 flat, about 1% higher on the spot. Hindalco is down 2%. IGL, and this is the risk, city gas distribution companies we were talking about with Mr. Kirit Parikh. IGL and MGL starting about 3.5% and 4% lower. Gujarat Gas is down about 1 1/3%, and so on and so forth out there. All right. So that's market opening, down about 45 points. Harsha Upadhyay is now joining us. He's President and CIO Equity at Kotak Mahindra Asset Management Company. He's our market master of the day. Harsha, it's always a pleasure. Great to have you with us here on the program. Thanks very much. I mean, just incredible, right? The outperformance, even on a day-on-day basis, which I reckon you will agree, you could be on any particular day making up for previous outperformance or underperformance. But even if you stretch time frames, the U.S. market especially is going one way, and the market here continues to hold, if not gain. Your sense, Harsha, from here?
Good morning, Prashant. Clearly, I think India has been a bright spot in an otherwise challenged global economy, I would say. While we have done much better than most other markets in the recent past, the trend also continues. But we need to remember that we can't be immune to the kind of volatility that is likely to be there in the global equity markets. Having said that, I would say that the problems at Indian economy is much lesser as compared to what you would see globally. For example, the negative real interest rates across the globe is much higher than what we are witnessing in India. So to that extent, the interest hikes that would be required in Indian economy would be a lot lesser. So the growth impact is going to be a lot lesser. Even after a couple of interest rate hikes, our economy has been resilient in terms of growth. Whereas most other developed economies, whether you look at US or Europe, are already seeing very, very significant declines in growth rates. So for them, the problem is much severe. And for us, while we can't be immune to what's happening in the globe, I think we can do this volatility. So all the long-term investors who are using this as an opportunity to build their portfolios or to increase equity allocations will be doing well over the next 3 to 5 years.
Harsha, hi, good morning. Good to talk to you. So, let's talk about some news based sectors. What's the approach at Kotak Mutual Fund for city gas players? And they did really well. They went through a period of sustained bull market, remain compounders. But over the last 2 years, there have been headwinds. How do you approach it? Because most of them remain monopolies, but there's cost pressure. Your approach?
Good morning, Anuj. As you rightly mentioned, I think these are near monopolies, and there is a lot of moat around these businesses. There is a steady improvement in growth that you would see over a period of time. But obviously, what has happened over the last 12-18 months in terms of price hikes has been difficult for some of these players to manage. While until now, they have managed their margins broadly, taking the consumer prices up. But the recent hike is going to leave some pain in the short term until they manage their overall cost dynamics. But we do believe that what we have seen in the 12-18 months in terms of gas prices may be behind us, and going forward, very unlikely that you will see this kind of price increases. Probably you can see gas prices peaking out as well. So given that context and the fact that these are near monopolies, we continue to hold a little bit of position in city gas distribution at this point of time. Not a very large exposure, but we do want to be present in this segment. And as gas prices come off, we would like to review our position to increase.
But may go up before they come down, Harsha, because of what's happening in Europe. Global gas prices, that is. Harsha, in terms of things that you are looking at in a constructive way, because you're still getting money as a fund and the industry is getting money. So where are you deploying that? Where are you seeing opportunities, outsized moves which perhaps are unwarranted, where, you wait out this period and, you were in for some outsized gains. Which are those areas according to you?
In the last couple of months, we have increased our exposure to banking and financials. Within banking and financial, it's been mostly large banks because that's where we believe, while on one side you are seeing credit growth picking up, you also won't have the pain of cost of funds going up because they are reasonably strong CASA ratios across the board. Another pocket where we have been adding to has been autos, more particularly in the passenger vehicles, while we have some exposure to two-wheelers and commercial vehicles. But we do believe that passenger vehicle segment is likely to see very, very strong growth. And some of the headwinds that we had seen in the past, for example, the chip shortage or the commodity cost pressures, etc., also seem to be kind of normalizing. So we do believe that these two segments can be our performers as we go ahead.
Okay. The market, by the way, just look at that. The Nifty's moved in the green once again, and it just tells you about the resilience of the Indian market. Though the city gas stocks, of course, still remain down, which is very interesting. What's doing well apart from ONGC? Well, you have a couple of other names like HPCL doing well, NTPC is higher, a couple of other names. Reliance is clearly helping. I think that's a big factor in today's move. Just pull out the intraday chart of SBI. And that also has moved to high point of the day, or the morning rather. So clearly, a lot of these stocks seeing buy on dips. Harsha, the other factor for this market has been domestic liquidity, and that remains as strong as ever, right? I mean, nothing has sort of shaken that belief of mutual fund investors. Do you think that is something which will keep our markets in good shape and may not lead to, even if we see the kind of global meltdown that we are seeing, may not lead to the kind of declines that we used to see, or we had become used to see earlier, say in 2007-8?
Domestic inflows are a big question for our markets in terms of reducing volatility, I would say. But again, even here, we need to remember that last quarter, that's July to September, we have seen a bit of moderation, nothing alarming. The SIP numbers still continue to be growing on a month-on-month basis. We are at record levels now. That continues to be the long-term trend, which also is more sticky. So I would say that quantum should continue giving a lot of support to the market. Whereas if you look at redemptions, they picked up a bit when Nifty hit levels of close to 18,000 last month. We have also seen lesser inflows into some of the existing funds, simply because I think at higher valuations, investors were a little cautious. So both these factors put together, despite the fact that SIP numbers are very, very strong and growing, we have seen moderate numbers overall for the flows into the mutual fund industry in the last quarter as compared to previous 12 months or so. So that remains a factor to watch out for, but I really do not see a situation where domestic flows will turn into negative, and that would put additional pressure to the market. That may not happen, but the kind of cushion that we were seeing for the entire October to June period, October of last year and June of this year, maybe a little bit is going down at this point of time.
Okay, yes, that clearly is helping on margin. What's your view now on large cap IT, Harsha? Because that is where we have seen the maximum pain. But of course, before that, we had seen this huge re-rating as well. And valuation-wise, we perhaps are still, compared to the averages, still at premium. So how do you approach this space now?
Yes, what you said is absolutely right. The valuations are still one standard deviation above the long-term averages for the IT sector. Whereas there are question marks in terms of how the growth momentum will unfold as we go ahead. We have seen a huge amount of liquidity tightening across markets, mostly the developed markets. And consequent to that, if there is any further deeper pain into financial markets and financial services companies, how that would feed into domestic IT services business is something that you have to keep evaluating. Because even today, roughly about 1/3 or slightly more than that is coming from BFSI segment. And if that segment is going to witness further pain because of what's happening in the global economy or otherwise, then how would the deal momentum would continue? What would happen to the kind of IT budgets in 2023, etc., would be a real question to answer. So to that extent, while on overall basis, you may see that this sector has underperformed quite sharply and has corrected a lot, but still it is one standard deviation above long-term average. So to that extent, we have remained cautious on the sector.
And since you mentioned autos, and I remember the big call that Nilesh also made 1 year back about the under ownership of autos and how that will play out. But now, Harsha, while we've seen the massive rally, again, if I go back and compare the valuation premium, if it's highest in any sector right now, it's for autos, at least on a 10-year period. Do you think the market assumes that maybe that's because the earnings have not picked up yet and they will now? Or is this just because, now it's becoming a bit of a overcrowded trade instead of being, the underweight trade earlier?
One is automobiles is a very, very cyclical industry. So to an extent, whenever you are seeing an inflection point, the valuations would obviously assume part of what is likely to happen and adjust themselves. So to that extent, I think the kind of uptick that we are likely to see in terms of growth or in terms of margins is already priced in. But we do believe that it can surprise on the upside and it has longer legs to move further on. So to that extent, we continue to remain positive, but obviously, to an extent, the valuation comfort has reduced as compared to where we were a couple of quarters back.
Okay, so that's on the automobile space. One last question then, Harsha. What is, to your mind, the biggest risk for our market? Do you think despite the resilience, is there a risk that our market can go and break the recent lows, or are you reasonably certain that that may not happen?
See, it's always difficult to predict what would happen in the very short term, but definitely I think our market is going to be more resilient than the global market. I think that one can safely assume. But what levels, etc., it will be very difficult to say. Overall, I think whenever the dust settles in the global economy, I think India should get a higher proportion of global flows, as well as the domestic flow should also improve quite a bit. And we are also at the beginning of the new corporate profitability cycle. I mean, I don't think the transient pressures that we have seen in terms of commodity costs, etc., would have any meaningful impact on the longer term trend of upcycle in corporate profitability. So overall, I think over the 3 to 5 year period, Indian market should definitely give reasonably strong returns. But what happens in the next 1 or 2 quarters, I don't think it's fair to predict on that.
Harsha, do you own any of, within financials, which of course you own, do you own any gold finance companies? Because that is one area which has done the worst, right? In terms of pure share price performance. And if you have a view broadly on the space.
No, we have been more positive on banks rather than non-banking financial companies across the board. And the reason is simple. Whenever the interest rates start to harden in an economy, the banks have a better handle on cost of funds, and the NBFCs will be moving in line with what happens in the market in terms of cost of funds. So that's where we believe that in terms of spreads or in terms of margins, banks are in a better position to manage that as compared to NBFCs. And also the business is more diversified than any of the single vertical focused NBFCs as well.
No, absolutely. Got that. Auto components as a space, any particular areas? We had a recent new listing as well, Harsha. Many believe that, that may be a better route to play, and because it provides some diversification as well, rather than single stock OEMs. Auto perhaps is a better way to play the theme. Any thoughts on what do you like in that space? Which segments particularly?
We do have exposure to auto ancillaries across the board, depending on liquidity and the size of each of those businesses. We do have exposure across our funds, depending on the mandate. But clearly, I think one has to evaluate which are the markets that they are exposed to. While it may give you diversification, it may also give you additional risk. For example, if an auto ancillary is more focused on European market, for example, then that would bring in additional growth concerns. So you have to be careful in terms of choosing some of these auto ancillaries. But by and large, I think most of these companies which are focused on domestic auto business are likely to see better days going ahead.
Harsha, we'll leave it there today. Thanks a lot for joining us. Good talking to you as always. The market, by the way, has taken a bit of a turn on the downside, but it's very volatile. I mean, it's just really single ticks are worth 20-25 points on the Nifty. It's just all over the place, really. Every dip gets bought, and at higher level there is some selling. So I think it's going to keep us on our toes for a better part of the day, I guess. We'll take a break. Up next, we'll connect with Rakesh Sharma, Executive Director at Bajaj Auto, to discuss their September auto sales. Also, we'll be joined by the CFO at Federal Bank, Mr. Venkat Raman Venkateswaran, to discuss their quarterly update and, of course, outlook going forward.